Gearing ratios. Risk ratios and gearing measure an organization's ability to meet its long-term debts. In addition to managing profitability and liquidity, organizations will also manage risk. High gearing implies high borrowing, meaning an organization has a high amount of interest to pay whether profits are made or not. Levels of gearing vary enormously between industries. Organizations requiring high investment in tangible assets are commonly highly geared. Consequently, it is difficult to generalize about when capital gearing is too high. However, most accountants would agree that gearing is too high when the proportion of debt exceeds the proportion of equity. Despite its risks, borrowed capital is attractive to organizations, as lenders accept lower rates of return than equity investors. This is due to their secured position. Also, interest payments, unlike equity dividends, are corporation tax deductible. Financial gearing is debt divided by equity or debt divided by debt plus equity. This is long-term debt as a percentage of equity. Financial gearing looks at the proportion of owner's capital and borrowed capital used to finance the business. A high level of gearing indicates that the company relies heavily on debt to finance its long-term needs. A large proportion of borrowed capital can be risky, as interest and capital payments are legal obligations and must be met if the company is to avoid insolvency. Whereas with equity, there is no obligation on the company to make payments. The ratio could be improved by reducing the level of long-term debt or increasing the level of equity used, or both. Operating gearing is fixed costs divided by variable costs. Operating gearing is a measure of the proportion of an organization's costs that are fixed against costs that are variable. High fixed costs means if profits fall, paying fixed costs may become difficult. Operational gearing is the effect of fixed costs on the relationship between sales and operating profit. High fixed costs increase operational gearing. Interest cover is operating profit divided by interest costs. Rising interest rates and declining profits will lower interest cover and may be an indication that an organization is in distress. Interest cover is sometimes known as income gearing. It looks at how many times the company's operating profits exceeds its interest payable. The higher the figure, the more likely the company is able to meet its interest payment obligations. Anything in excess of 4 is usually considered to be safe. A decrease in the ratio indicates that the organization is facing increased risk of not being able to meet its interest payments as they fall due. This ratio can be improved through increasing operating profits, for example, through charging higher prices, increasing sales levels, reducing costs, or through reducing debt levels to reduce interest costs. Dividend cover is profit after tax divided by dividend paid during the year. Dividend cover asks the question, is dividend yield sustainable? It is a safety check in that it looks at can the organization continue to maintain paying out the yield calculated by dividend yield. It takes the profit after tax figure of an organization, which is the profit an organization has available to either reinvest in the organization or pay out to shareholders, and divides it by dividend actually paid during the year. A high dividend cover suggests that the dividend yield is sustainable.